Breaking news, April ADP employment coming in with a gain. You ready for the number? 192,000 jobs. It is slightly hotter than the 183,000 the street expected, not by a huge amount, but the biggest sectors, leisure and hospitality, construction and education, also health services. Pay growth for those who stayed in their jobs in April was flat at 5% of those job changers, 9.3%. That's down from 10.1% last month for those switching gears in terms of their jobs. Joining us right now is Nela Richardson, chief economist at ADP. Good morning to you. Give us your highlight or your read through of what this number really means.
It means that job creation in the first part of 2024 looks like a lot like it did in the first half of 2023. We saw the slowdown in hiring in the second half of 2023, and now it looks like hiring is picking up. The 3-month average is stronger than the previous 6 months. So the snapshot here is hiring is still strong, and wages are not falling as fast as they were. The wage growth is not falling as fast as it was earlier in our 6-month outlook.
Okay, so if Jay Powell is watching you now, you would tell him what and what to think about all of this?
Well, I think I'd tell him what he already knows, which is tread carefully. Because what we're seeing, even if you look at that job changers pay growth that you just cited, it ticked down a little bit from last month and went from 10% to 9.3%. But that's not the trough. It was actually lower early in the year. It bottomed out at 7.6% in February. And we look at this index very carefully because it's the most sensitive to real-time labor market conditions. So the fact that we're seeing a little more strong growth in pay growth for people switching jobs and still pretty high job openings means that wages are not playing along with a 2% target yet. They're still higher than that 2% target would allow for. And so as we look at what the labor market's saying, it's saying to the Fed, we are a smoking ember and we could ignite and watch wages. Wage growth is still strong.
And we could ignite, meaning ignite even further?
Yeah. That was what was interesting to me in the last couple of months. We've seen some steady declines in pay growth over the last 6 to 8 months. But in March, something different happened. We actually saw pay growth rise. And even though it's come down from that March level, it's still stronger than we've noticed over the past 6 months. And so I'm really watching pay growth. That pay growth is concentrated at the bottom quartile of the pay distribution. That's an important note because it means a lot in terms of consumer spending. And I think it sets the tone for the rest of the year in terms of not only inflation, but also GDP growth.
You know, we talk about AI all the time, AI coming to take our jobs, technology coming to take our jobs. Therefore, you would argue higher productivity longer term. Is any of that playing out in reality when you look at numbers like this?
No, it's hard to see it in real time right now. But it is playing out, and I think it's going to be a longer-term play. Look, productivity is the answer to all the economic woes that we see. It's the answer to the inflation because you can produce more output with less input over time. And it's the answer to wage growth. It's how to keep wages rising and outpacing inflation. So these new technologies have the capacity to increase productivity, and that is good, but it depends on how they are deployed. And I think companies are still in the early stages of figuring that out.